government's coal price cap also comes into effect from today. Let's get more on this. I'm joined by Samantha McCulloch, the Chief Executive of APPEA, the gas peak industry body. Thanks very much for your time. So this figure, I'm just trying to sort of figure out how many actual projects at this point have stopped, have paused, are not going ahead or are going to actually be delayed. Can you put a figure on that in terms of the projects or the dollar value?
So Tom, thanks so much for having me. There's considerable uncertainty in the market, and what we have is around $20.7 billion of oil and gas investments planned on the east coast of Australia that are now facing considerable uncertainty because of the government's reforms introduced last week. And with the announcement of the Senex project being paused, we're seeing the very immediate and very real consequences of this intervention only a week after it was introduced. So
is that the only one though? Senex have said they're pausing it and they're mulling over what the ramifications will be, but the others are just, we'll see, it's uncertainty.
All of these projects will be under assessment now to understand what the impacts of these interventions will be on individual projects. And we should clarify, the extent of these market interventions are really unprecedented and far-reaching. There is, of course, the $12 price cap that's proposed to be introduced for 1 year. The order was released yesterday. It comes into effect today. The second part of the reforms is a mandatory code of conduct that will allow the government to essentially regulate a rate of return on these investments. So, of course, as we work with the government through the detail of this code of conduct, these projects will be facing considerable uncertainty in terms of what that will mean for their future investments.
But as we are right now, it's just Senex is paused. That's the one concrete action, for want of a better word. I think the others will wait to see. They're looking at things, they're seeing how the beyond 12-month will stack up, because there's no future projects aren't affected by the 12-month cap. So that's one aspect.
Well, Tom, just to clarify though, in terms of the price cap, it applies to any existing production licence. So there will be projects that have a production licence but are yet to start producing, are yet to bring that new supply into the market.
But are any of them going to happen in the next 12 months anyway?
Well, that's a question for individual projects, but our concern as an industry, we take our obligation to our customers seriously. We want to ensure that we continue to keep the gas in the pipelines, to keep that supply to Australian households and industry. And what we're seeing is the government's intervention is actually already having the opposite effect of what was intended and, of course, of what is needed in terms of bringing new supply onto the market to reduce those prices.
It's one pause in terms of concrete action. But just to clarify, you'd have oversight of this. I'm not asking you to necessarily name companies or projects, but are any of them actually going to be producing gas domestically in the next 12 months?
There are projects that are looking to start producing in the near term.
In 12 months?
Many of these projects might be looking at what the pace of bringing that new supply onto market because of the uncertainty. Of course, there is the price cap that comes into effect today, but the mandatory code of conduct will be
which we'll get to in a moment. I'm just trying to clarify that 12-month period. Is there anything that realistically could produce gas in that period?
There are well-developed projects in the pipeline that could be producing gas, but I couldn't give you a figure in terms of what that would look like.
But in that 12 months?
Potentially, yes.
Potentially, okay. And beyond that 12 months is the other thing the government's still working on. What are you looking for there? Clearly the government is saying gas prices, we can't reliably, they're not being reliably provided to Australians at a reasonable price. So what would you push back and counter with? What would be acceptable intervention?
Let me make 2 points on the price cap. Of course, the APPEA itself has highlighted that wholesale gas contracts have been struck at an average of $12 or $12.34 per gigajoule of gas in recent months. So what we were seeing was the market working, the market deals were being struck at competitive rates between suppliers and producers. What we've now seen, though, is unprecedented intervention, and in some ways it's not so much about the price of the cap, it is actually the nature of the intervention, how it was introduced, and this ongoing regulation of a rate of return that these investments can earn.
When
and
you were
we
saying
need to recognise that these investments, these companies can spend tens, even hundreds of millions of dollars before they earn a cent, because it's a high risk, it's a capital intensive business, and we need certainty for that investment. And what we've seen in the last week, in the last couple of weeks, is
Okay,
the government intervening with no notice and no consultation, and frankly, that's making investors very nervous.
When we talk about production costs, though, it's important to note, from my understanding, production costs will factor in an annualised amount for that initial investment. So whilst you say companies spend a lot of money, and they do, getting things up, once we get to a production cost which might be $9 or $10, that's not for that year. That takes into account the life of that extraction and the annualised amount. So whilst you're pointing out there's a cost there, as long as that production cost is still well below 12, they are recouping the money from that initial extraction and
we actually,
exploration.
in terms of the rate of return that's going to be imposed through a mandatory code of conduct, we're yet to see the detail of that. We will work with the government in the course of the next month or two to iron out what that would look like. But frankly, it's not conducive to investment for the government to be stepping in and saying, this is a regulated rate of return, here's what we think a particular project should be able to earn based on investments
I'm just trying to clarify
that
point, because it's a complex thing for non-experts to understand. When we talk about rate of return on a gigajoule, that does factor in all those upfront costs you were talking about, doesn't it?
Well, we don't know yet, so we're still looking at the details of this.
But I'm talking about when a gas company says, here's our cost of production, that does factor in their initial outlay and then spread that out over the time of the extraction.
I think what some of the concern is then the rate of return that the government will impose on the industry. This is an unprecedented and far-reaching intervention into the market. It's dismantling the market entirely. And what we are seeing, Tom, is that actually the costs of production are increasing. We're seeing higher costs of capital, and we're also looking to develop fields that will be of higher cost.
And that's a fair enough argument to mount once we get to those ones. But I'm just trying to clarify, you're the peak body. When we hear about here's the cost of production, you're keen to mention the initial outlay. That is factored in the cost of production, isn't it?
Well, yes, but this is actually not what the new code of conduct is driving at. It's driving at what is the rate of return that can be earned on what is a high risk and capital intensive industry. And our concern as an industry, we want to ensure that there's supply coming to the market. One of the reasons we're seeing higher costs in the domestic market is because we're seeing diminished supply, and we need to ensure that we've got the gas in the pipelines, delivering to households, delivering to industry.
If there's less supply, that doesn't mean it's costing more to produce. That just means you can charge more for it.
Well, what I'm saying, Tom, is actually that the new fields coming online will be higher cost. And it's the tightness in the market, because we still have that strong demand there. And in fact, the role of gas is growing, particularly in power generation.
But the cost of production is actually nothing to do with demand. It's whatever production is. It's the area, it's the development, it's what the initial exploration costs.
This is not an industry that's akin to maybe a pipeline or a road. This is a high-risk, capital-intensive investment. And for the government to say, this is the rate of return you can earn, and we won't tell you that. This is going to apply retrospectively to existing fields. That is creating a considerable amount of uncertainty and nervousness among investors. And that's why we're seeing these projects going on pause.
But the cost of production isn't actually affected by tightness. The cost of production is the cost. It's what the exploration costs, it's salaries, it's all those things.
The prices are a factor of supply and demand.
Price is different. I'm saying cost of production. That's not affected by tightness of market. Cost of production is what it costs to produce.
The cost of production varies across the industry, and what I'm saying is that cost of production is increasing, and actually it's because different fields are being developed.
Absolutely, and you go to the lowest cost first and you go on. That makes sense, but it's not affected by tightness. The cost of production is not affected by a tightness of market.
The cost of production is actually, but not what is being driven at in terms of the mandatory code of conduct. The concern of the industry is that the government will step in with very little consultation and no notice to say that we are going to regulate the rate of return that you can make on investments. This is a concern not just for our industry, but it's a concern for all industries, frankly, Tom, because what we've done now is send a very strong signal to our international investors, to domestic investors, that Australia is not a safe and secure destination for that investment, because at any given moment, the government can step in and retrospectively determine what rate of return you can make on those investments. On
the rate of return, one of the big things that got attention from the government was industry saying they've been charged $30, $35, $40 a gigajoule in some cases. Is that too high a price? Is that gouging?
Tom, so as I just indicated, the APPEA itself keeps a record and publishes the average price.
Average, I know that.
Which
We've
is
gone through that.
$12.
I'm talking about individual contracts that have been that high. Is that gouging?
If there are individuals that high, contracts that high, I would suggest to you that's in the retail market, which is not the subject of the price cap. The wholesale market, the deals are being struck at around $12 a gigajoule.
Right, but they've had to do those deals and it's a high lot of the market. Is that sort of price gouging?
$12 a gigajoule.
$35, $40, is that gouging?
Well, the thing is, Tom, that these gas contracts can be quite complex. So it depends on what are the transport costs, where are you getting the gas
You're
from,
never going to get anywhere near the cost.
how much,
Come on,
the
$35,
interruptibility.
$40. That's a massive, massive.
But I would
profit,
suggest to
isn't
you
it?
that, again, they are not deals that are being struck in the wholesale market. They might be for smaller quantities under different conditions, potentially in the retail market. But where the gas producers are selling gas into is the wholesale market, and the ACCC itself regulates this, keeps an eye on the prices, and has published that the latest prices that those agreements are being struck at is about $12.34.
Which is the average, but anyway.
Which is the average.
All right, we know it's a busy time for you. I hope you get some sort of a break. Samantha
Thank you.
McCulloch from APPEA, thanks for your time.
Thanks so much, Tom.